Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 123, recorded here on July 7th, 2024. This podcast is for entertainment only and is not investing advice, so please do your own homework. All right, we'll start with the market update outlook and then get into the top Bitcoin news of the week. The S&P 500 kicked off the second half of 2024 with its best weekly performance since late April on Friday. The advance was driven by labor market data that has supported the case for Federal Reserve interest rate cuts, some dovish commentary from Fed Chair Jerome Powell, and the minutes of the central bank's last monetary policy meeting. And electric vehicle giant Tesla rediscovering some of its mojo. Remarkably, the S&P is now within striking distance of the 5,600 level and is close to topping the year-end target of several brokerages that have scrambled to keep up with the inexorable bull run. For the week, the S&P 500 added 2%, while the tech-heavy NASDAQ Composite gained 3.5%. The blue chip Dow climbed 0.7%. Looking ahead to next week, Wall Street will have its hands full with the eagerly anticipated June Consumer Price Index report and the start of the earnings season. My, is it that time already? The economic calendar will be dominated by the CPI report and Federal Reserve Chair Jerome Powell's testimony to Congress. The CPI print is forecast to show a 0.1% month-over-month rise in inflation, while the annual core inflation rate is expected to be unchanged at 3.4%. But that's not what we really see in the real world, is it? The spotlight will also be on the second quarter earnings season, which will be kicked off by top U.S. carrier Delta Airlines and soft drink giant PepsiCo, along with major banks including Citigroup, JP Morgan Chase, and Wells Fargo. Getting into the top Bitcoin news this week, I'm going to start with No BS Bitcoin, block 851078, important news of the week. A quick synopsis, there's a few things in here we're going to dive into a little bit deeper later on. OpenSats announced its fifth wave of Bitcoin grants for 10 more Bitcoin projects. The nonprofit also granted long-term support to Rustnoster maintainer Yuki Kishimoto and launched the OpenSats Education Initiative focused on supporting Bitcoin education and outreach worldwide. The U.S. government has agreed to release Samurai Wallet founder William Lonergan Hill, also known as T-Dev, on bail. According to a letter filed on July 3rd, Hill is expected to appear in the Southern District of New York on July 9th or 10th, 2024. The German Federal Criminal Police Office, BKA, continued its seized Bitcoin sell-off this week, mirroring similar actions by the U.S. government recently. Mt. Gox has finally begun its Bitcoin repayments to creditors, ending a decade-long wait for some users. Coinbase has officially partnered with the U.S. Marshals Service, part of the U.S. Department of Justice that is responsible for managing seized and forfeited assets. Bitcoin Core announced a new security disclosure policy for publicizing security-critical bugs in core versions that are end-of-life and no longer receive maintenance updates. The Danish Financial Supervisory Authority, or DFSA, has denied reports suggesting that the regulator plans to ban personal or non-custodial Bitcoin wallets. Australia-based Bitcoin miner Iris Energy announced raising $413.4 million through stock offerings since mid-May to fund its 2024 expansion plan. Bitcoin mining and energy technology firm CleanSpark has acquired Grid Infrastructure in an all-stock deal valued at $155 million. The Qualys Threat Research Unit, TRU, has discovered a remote unauthenticated code execution vulnerability in OpenSSH's server On glibc-based Linux systems, Bitcoiners running Lightning nodes with remote SSH access are urged to update to version 9.8p1 as soon as possible. The United States Supreme Court decisively overturned the Chevron deference last week. I actually wrote about that in my blog post and have a link to that in the show notes. We'll go over that at the end. Also, there'll be links to all, I'll put the article in for No BS Bitcoin in the show notes, and you can look at the links in the articles here. AU10TIX, an Israel-based ID verification and compliance platform hired to verify user identities at X since last September, reportedly left a set of administrative credentials exposed for over 18 months. These provided access to a logging platform containing links to identity documents, including usernames, dates of birth, nationalities, ID numbers, and images of uploaded documents. Fantastic. Gotta love KYC. A federal jury in Greensboro, North Carolina convicted a 24-year-old man for leading a conspiracy to attack and kidnap U.S. residents in their homes to steal their Bitcoin and other digital assets. Good reason why you want to stay low profile and also keep your keys in separate locations so you cannot fall victim to the $5 wrench attack. The two-factor authentication app Authy leaked the phone numbers of 33 million users. Oops, not good. ZapConf, a virtual conference focusing on the Lightning Network and Nostr, will take place on September 21st to 22nd, 2024. The next edition of the Bitcoin Atlantis conference is set to take place in 2028. The event organizers decided to align Bitcoin Atlantis with the Bitcoin halving cycle, making it a unique event every 4 years. And finally, BTC Pay Server announced BTC Pay Day Riga, which will happen right after the Baltic Honey Badger and Nostriga conferences on August 26th, 2024. Next up from Bitcoin.com news, this was posted 2 days ago. Germany's BTC wallet sees inflows. Mt. Gox moves billions. U.S. government transfers 13.6 million unnoticed. This movement, along with transactions involving large Bitcoin wallets like those of the German government and Mt. Gox addresses, has caused unease within the crypto community. On Thursday, the German government divested $175 million worth of Bitcoin, paper hands, bringing the total down to 40,359 Bitcoin. Subsequently, Arkham Intelligence reported via X and its on-chain Explorer that the wallet received inflows of 1,915 Bitcoin from Kraken, Bitstamp, and Coinbase. Arkham further noted that 1,047.4 Bitcoin, or 57.2 million, has been moved out of their wallets this morning, 547.4 Bitcoin, or 30.1 million, to flow traders, and 500 Bitcoin, 27.1 million, to 139 PO, likely deposit for institutional OTC service. The German government's Bitcoin transfers coincide with Mt. Gox preparing to distribute funds to creditors. On Thursday, Mt. Gox transferred 47,228.7 Bitcoin to a different address and moved 142,846 Bitcoin cash, valued at just over 40 million. Additionally, contributing to the activity involving both Germany's and Mt. Gox's transfers, the U.S. government transferred 237 Bitcoin on July 4th. How about that? Worth 13.67 million at current exchange rates. These addresses have undoubtedly been among the most closely watched wallets in recent weeks. And that's, a lot of people think, why the price has plummeted 20% from the recent highs. Cheap sats, so buy the dip if you can. And I'm sure will rebound once the paper hands are done doing their thing. And we'll see what the Mt. Gox people do, if they sell or if they hang on to it. But sounds like BCH is going to, or Bitcoin Cash is going to get pummeled way worse than Bitcoin if this selling actually happens as it's expected. FUD of the week next. We're going to hear from Peter Schiff, our favorite Bitcoin hater. Peter Schiff, Bitcoin bear market has much further to go. Ether to crash to $1,500. This was from Bitcoin.com. Economist and gold bug Peter Schiff has been vocal about Bitcoin on social media platform X this week. On Friday, he noted that Bitcoin is traded as low as $53,550, reflecting a 27.5% drop from its record high in US dollars and a 38.5% drop when priced in gold. Schiff cautioned, the bear market is a long way from over. I didn't realize we were in a bear market. He shared a Bitcoin price chart emphasizing that Bitcoin is at critical support and stressed that if it doesn't hold, the price could drop significantly. If it doesn't hold, look out below. It's a long way down, he warned. On Saturday, Schiff attributed the Bitcoin decline partly to Mt. Gox repayment-related sales, but argued that it also exposed, quote, the myth of institutional demand. He stated, if such demand really did exist, buyers would jump at the chance to buy the Mt. Gox Bitcoin off the market. Schiff also commented on spot Bitcoin exchange-traded funds, suggesting that while Bitcoin ETF buyers are still holding, there's no sign of panic yet. Based on trading activity, it looks like Bitcoin ETF buyers are still hodling. So far, there's no sign of panic. It will likely take a much larger drop in Bitcoin before they finally capitulate. That may come as soon as next week, especially after another big sell-off this weekend, he opined on X Friday. The gold advocate didn't limit his bearish predictions to Bitcoin. He also forecasted a price drop for Ether. On Friday, he noted Ethereum is also breaking key support. It's trading below $2,900, down 30% from its March high. He concluded, I think a crash down to $1,500 is coming. It looks like those buying the Ether ETF rumors couldn't wait for the fact to sell. At the time of writing, Bitcoin is trading at $57,028, while Ether is at $3,015. So Peter thinks we're in a bear market, and he still doesn't understand Bitcoin, and he obviously can't zoom out. So rest in peace. Next up is from Cointelegraph. This was July 5th, 2024, posted Bitcoin miners near capitulation as profits dry up alongside Bitcoin's sell-off. According to market intelligence firm CryptoQuant, Bitcoin miner capitulation metrics are approaching the same level as the market bottom following the FTX crash in late 2022, signaling a possible bottom for Bitcoin. Well, this is interesting. Miner capitulation is a process in which some miners reduce their operations or sell a portion of their mined Bitcoin and reserves to stay afloat or earn yield or hedge their Bitcoin exposure. CryptoQuant analysts highlighted multiple signs of capitulation that emerged over the last month, during which time the Bitcoin price dropped 13% from 68,791 to 59,703. One of those signs is a significant decline in Bitcoin's hash rate, the total computational power that secures the Bitcoin network, which has experienced a 7.7% decline to hit a 4-month low of 576 exahash per second after hitting a record high hash rate on April 27th. And then there's a quote here, Bitcoin miner capitulation mirrors December 2022 levels with a 7.7% hash rate drop similar to post-FTX collapse conditions. Such declines often signal potential market bottoms. Notably, the 7.7% drawdown mirrors an equivalent decline in hash rate in late 2022 when Bitcoin's price bottomed at 15,500 before surging more than 300% over the next 15 months. The CryptoQuant report also noted that for most of the period since the halving, miners have been extremely underpaid as evidenced by the miner profit-loss sustainability factor. As a result, miners have seen a 63% decline in daily revenues since the halving, when both Bitcoin's base block rewards and transaction fee revenue were higher. Total daily revenues have decreased from 79 million on March 6 to 29 million currently. Moreover, the revenue from transaction fees has fallen to only 3.2% of the total daily revenues, the lowest share since April 8th. Due to decreased revenues, Bitcoin miners have been forced to use their reserves to earn yield. CryptoQuant noted that daily miner outflows have spiked to the highest volume since May 21st, suggesting they may be selling their Bitcoin reserves. Outflows also spiked during May, red circles, although they did not reach extreme levels 2 times The 1-year average higher Bitcoin outflows suggest miners could be selling. And of course, as we all know, miners are the natural seller in the Bitcoin ecosystem because they use the proceeds to fund their operations when they need to. And it sounds like they need to now. This sell-off by miners, along with sales from Bitcoin whales and national governments, has contributed to Bitcoin's recent price pullback, which saw Bitcoin fall to a 4-month low of $53,499 on July 5th. Cheap sats, everyone. The decline has also impacted Bitcoin's hash price, a measure of miner profitability per unit of computational power. Currently, the average mining revenue by hash is 4.9 cents per exahash per second, just above the all-time low of 4.5 cents reached on May 1st. According to an earlier report by financial services firm Cantor Fitzgerald, some of the world's biggest mining companies would be forced to capitulate if the market price of Bitcoin plummets to $40,000, highlighting the predicament of the mining industry. Mining is a tough, tough business, that's for sure. On a positive note, since we listened to Peter, now let's hear what Fundstrat's Tom Lee says. He predicts, this is from Bitcoin.com news, published yesterday. Tom Lee predicts pretty sharp rebound for Bitcoin, expects to see 150,000 Bitcoin this year. Thomas Lee, managing partner, and who's, by the way, permabull, especially in the stock market, so you got to take it with a grain of salt. But Tom Lee, managing partner and head of research at Fundstrat Global Advisors, shared his Bitcoin price prediction and expectations following the Mt. Gox distribution in an interview with CNBC this week. Fundstrat is an independent financial research boutique providing strategic market insights, and Lee, with over 25 years of equity research experience, previously served as JP Morgan's chief equity strategist and managing director at Salomon Smith Barney. Lee remains bullish on Bitcoin, predicting it could still hit $150,000 by the end of 2024. He explained that several factors support this forecast, including the anticipated resolution of the Mt. Gox overhang, which has burdened the market for a decade. Bitcoin's probably suffering from the Mt. Gox starting distributions in July. That was a huge overhang for many years, he shared, adding that he expects a sharp rebound as the disappearance of one of the biggest overhangs would be a significant positive for crypto investments, the Fundstrat head of research said. I think it's a reason to actually expect a pretty sharp rebound in the second half. Defunct crypto exchange Mt. Gox has started repaying creditors in Bitcoin and Bitcoin Cash, its rehabilitation trustee revealed on Friday. The firm is set to repay approximately 142,000 Bitcoin, currently valued at nearly $9 billion. In addition to the removal of this long-standing overhang, significantly reducing selling pressure on Bitcoin, Lee also cites the potential for easing monetary policy from the Federal Reserve and the positive impact of Bitcoin exchange-traded funds on market demand as key drivers for the projected price surge. The head of research has held his $150,000 Bitcoin prediction for some time. In February, he doubled down on that forecast, calling Bitcoin sound money, adding, I think it's proving to be useful. It's been a great store of value. It's been a good risk asset. It's also incredibly secure. So, Tom gets it. Next up from BitcoinNews.com. This was posted on July 5th, 2024. A little bit of a deeper dive into one of the news items that was covered earlier in the No BS Bitcoin piece. This one is called Bitcoin Core Developers Launch New Policy to Address Bugs. Bitcoin Core developers have introduced a new policy aimed at improving the disclosure and handling of security vulnerabilities within the Bitcoin network. This move comes as part of an effort to enhance transparency and security, addressing long-standing issues in the way vulnerabilities have been communicated to the public. Antoine Poinsot, a prominent Bitcoin Core developer, has emphasized the importance of this new policy. According to Poinsot, there's a dangerous misconception among Bitcoin users that Bitcoin Core, the software used by node operators to access the Bitcoin blockchain, is free of bugs. This perception is dangerous and unfortunately not accurate, Poinsot stated. The new policy aims to address the misconception by providing a more standardized and transparent way of disclosing vulnerabilities. Bitcoin Core has historically faced criticism for its handling of security-critical bugs. Poinsot and his colleagues acknowledged this in their communication to the Bitcoin development mailing list on July 3rd. They highlighted that both externally reported and internally discovered vulnerabilities were not always made public, leading to a false sense of security among users. Poinsot noted the project has historically done a poor job at publicly disclosing security-critical bugs, whether externally reported or found by contributors. He suggested that allowing more contributors to access information about safety bugs could help prevent future issues. The newly implemented policy categorizes vulnerabilities into 4 levels of severity: low, medium, high, and critical. This categorization is designed to help users and developers understand the impact and urgency of each bug. Low severity bugs are those that are difficult to exploit and have minimal impact. For instance, a wallet bug that requires access to the victim's machine would fall under this category. These bugs will be disclosed 2 weeks after a fixed version is released. Medium severity bugs have limited impact, such as local network remote crashes. These will be disclosed 1 year after the last affected software release goes end of life. High severity bugs can have significant impact, and similar to medium bugs will also be disclosed 1 year after the last affected release goes end of life. Critical bugs pose a threat to the entire network's integrity. Examples include manipulating Bitcoin Core to inflate Bitcoin's hard cap supply or committing a coin theft. The disclosure of critical bugs will be handled on a case-by-case basis due to their severe nature. The policy will be gradually adopted over the coming months. Poinsot noted that all vulnerabilities fixed in Bitcoin Core versions 0.21.0 and earlier have been disclosed as of July 3rd. Disclosures for versions 0.220 and 0.230 are scheduled for later this month and in August. The latest version, Bitcoin Core 27.1, will also follow the new policy guidelines. This move has been well received within the Bitcoin community. Eric Voskuil and another Bitcoin Core developer praised the initiative, saying many other projects have been on the receiving end of this misperception, and it has in fact caused material harm to the community. I don't know what precipitated this change, but props to you all for stepping up. And the article goes on to explain a little bit more about Bitcoin Core and what it is, which you can read. I will include a link in the show notes. Next article is also from BitcoinNews.com, and this one's entitled Craig Wright Has Assets Frozen in Legal Battle Against McCormack. The saga of Craig Wright and his contentious claim to be Satoshi Nakamoto, the enigmatic creator of Bitcoin, has been captivating the public. This tale took another dramatic turn recently as the UK High Court issued a worldwide freezing order against Wright. This decisive action, championed by Justice Malloy, aims to prevent Wright from moving assets to avoid paying substantial legal fees incurred by Peter McCormack, a prominent Bitcoin podcaster and critic of Wright. Craig Wright, an Australian computer scientist, has been a controversial figure in the Bitcoin community since he publicly claimed in 2016 to be Satoshi Nakamoto. Nakamoto is the pseudonym used by the person or group of people who created Bitcoin, the world's first and most well-known digital currency. Wright's claim has been met with widespread skepticism and has led to numerous legal battles. One of the most significant of these legal battles has been between Wright and Peter McCormack. McCormack, known for his outspoken criticism of Wright, publicly accused him of fraudulently claiming to be Nakamoto. These accusations were made in several tweets and a YouTube video, leading Wright to sue McCormack for defamation in 2019. The defamation case between Wright and McCormack has been a lengthy and complex legal struggle. Initially, Wright sought to clear his name and prove his claim to be Nakamoto by taking legal action against McCormack. However, the case took an unexpected turn when the court found that Wright had presented deliberately false evidence. As a result, Wright was awarded only nominal damages of £1. Justice Malloy, who presided over the case, noted that Wright's conduct throughout the litigation was dishonest and that he had engaged in a mendacious overall campaign to lay false claim to Bitcoin's assets worth many billions. This judgment significantly undermined Wright's credibility in his claim to be the creator of Bitcoin. In a significant development, the UK High Court has now issued a worldwide freezing order against Craig Wright. This order, valued at £1.548 million, or $1.9 million US, is intended to prevent Wright from transferring assets to evade paying the legal costs owed to McCormack. Justice Malloy granted this order in response to Wright's history of defaulting on payment orders and concerns about the potential dissipation of his assets. Justice Malloy stated the defamation claim should never have been threatened, commenced, or pursued. In these circumstances, our law would be in a sorry and sad state if a litigant in the position of Mr. Cormack is not able to recover his costs of having to fight that type of litigation. The judge highlighted that the impact of a defamation lawsuit is significantly magnified when pursued by someone like Dr. Wright, who is willing to invest large amounts of money in litigation. He ruled that McCormack, represented by the law firm Reynolds Porter Chamberlain, has a compelling case to recover $1.548 million in costs. The WFO against Wright covers a substantial sum, including the costs already awarded to McCormack and additional expenses related to Wright's dishonest behavior during the defamation proceedings. This order is part of a broader pattern of legal actions involving Wright, who has been involved in multiple lawsuits asserting his claim to be Satoshi Nakamoto. In another recent case, the Crypto Open Patent Alliance successfully challenged Wright's claim. The court found overwhelming evidence that Wright is not the creator of Bitcoin and had forged documents to support his claim. Judge James Mellor, who also presided over this case, declared that Dr. Wright is not the author of the Bitcoin white paper, and Dr. Wright is not the person who adopted or operated under the pseudonym Satoshi Nakamoto in the period 2008 to 2011. Attorneys for COPA stated Wright has invented an entire biographical history, producing one tranche after another of forged documents to support it. The legal battles surrounding Craig Wright have significant implications for the Bitcoin community. Wright's claim to be Satoshi Nakamoto has been a point of contention for years, and the recent court rulings further discredit his assertion. COPA, an industry group that includes prominent members such as Twitter founder Jack Dorsey's payments firm Block, hailed the court's decision as a victory for the entire open source community. For over 8 years, Dr. Wright and his financial backers have lied about his identity as Satoshi Nakamoto and used that lie to bully and intimidate developers in the Bitcoin community, a spokesperson for COPA stated. This ruling is seen as a significant step in protecting developers and upholding the integrity of the Bitcoin ecosystem. While the court's rulings have dealt a significant blow to Craig Wright's claim, the true identity of Satoshi Nakamoto remains one of the biggest enigmas in the tech world. The 2008 Bitcoin white paper, published under the Nakamoto pseudonym, is considered the foundational text of the cryptographic digital currencies. Despite numerous investigations and speculations, the real creator of Bitcoin has never been definitively identified. Wright's claim to be Nakamoto has been a central part of his legal strategy, but the courts have consistently found his evidence to be lacking. As the legal proceedings continue, the implications of these rulings will likely resonate throughout the industry. For now, the court's decisions provide a measure of justice for Peter McCormack and others who have been caught in the crossfire of Wright's contentious claims. And finally, a nice opinion piece here in Bitcoin Magazine this week. It was posted on July 5th by Colin Crossman, and it's entitled The Federal Reserve, Custodia Bank, and the Battle for Sovereignty. As it moves into the active appeal stage of the 10th Circuit, the ongoing legal battle between Custodia Bank and the Federal Reserve has garnered significant attention, especially given the involvement of various amicus briefs. A total of 7 briefs were filed on July 3rd, the last day for supporting or neutral briefs to be filed. This case has attracted significant interest from top-flight appellate attorneys, drawing 3 former solicitors general, 2 representing Amici, and Ian Gergengorn, who represents Custodia itself. In federal appellate practice, An amicus curiae, a friend of the court, brief allows non-parties to provide the court with additional perspectives, expertise, or insights. These briefs, submitted by states, individuals, organizations, or entities with a strong interest in the case, aim to highlight broader implications, advocate for legal principles, and ensure the court understands potential impacts beyond just the parties to the case. Among the briefs filed in the Custodia case, all of which are powerful and explore different aspects of the case, the one submitted by former Solicitor General Paul Clement stands out due to its comprehensive argument on the constitutionality of the Federal Reserve's actions. This article presents a high-level summary and analysis of each of these briefs, examining how each addresses the core issues at stake, starting with a more detailed focus on Clement's brief for the digital chamber. And just so everybody knows that basically Custodia Bank wants to be a 100% reserve bank that basically owns Bitcoin, and they applied for a Federal Reserve master license and were denied. And so they're basically suing the Federal Reserve over that. Paul Clement, who served as the Solicitor General under President George W. Bush, brings a brief on behalf of the Digital Chamber and the Global Blockchain Business Council. It's worth noting that Mr. Clement prepared this brief while freshly off his Supreme Court victory, taking out the Chevron doctrine in Loper-Bright Enterprises versus Raimondo. The Clement amicus brief in support of Custodia lays out a robust constitutional argument, primarily focusing on the Appointments Clause. This clause, found in Article 2, Section 2 of the U.S. Constitution, empowers the President to appoint officers of the United States with the advice and consent of the Senate. Clement argues that the Federal Reserve and its current structure violates this clause. The upshot is that the Federal Reserve Bank presidents are not appointed by the President with the advice and consent of the Senate, and removable by the President, as principal officers must be, nor are they appointed by the President, the courts of law, or the head of an executive department, and removable by the President or a principal officer, as inferior officers must be. Clement asserts that the Federal Reserve's board members, who wield substantial regulatory power, are not properly appointed under the Appointments Clause. This lack of adherence to constitutional procedures undermines the legitimacy of their actions, specifically including the denial of Custodia's master account application. By bypassing the constitutionally mandated process, the Federal Reserve operates with a degree of autonomy that the framers of the Constitution did not intend. The brief underscores the idea that the significant executive powers vested in individuals who are not appointed in accordance with the Appointments Clause are fundamentally unconstitutional. This argument is particularly compelling with respect to Custodia because it directly challenges the very structure and legitimacy of the Federal Reserve's decision-making process, bypassing the argument of whether or not granting a master account is discretionary. Another significant aspect of Clement's brief is the emphasis on judicial review. Clement argues that the actions of the Federal Reserve should be subject to strict judicial scrutiny to ensure they comply with constitutional and statutory mandates. Noting that the district court's opinion would render the Federal Reserve's actions unreviewable, he points out that the judiciary has a crucial role in curbing administrative overreach, aligning with the recent Supreme Court decision overturning Chevron deference. The Chevron doctrine, established in Chevron USA, Inc. versus Natural Resources Defense Council, required courts to defer to agency interpretations of ambiguous statutes. Clement's brief references the Supreme Court's recent move to overturn this doctrine, emphasizing that courts must independently interpret statutes rather than deferring to agencies. This shift reinforces the need for judicial oversight of the Federal Reserve's actions, ensuring they do not exceed their statutory and constitutional authority. Clement underscores the necessity of having an independent judiciary that can review and, if necessary, overturn decisions made by federal agencies that overstep their boundaries. Their protestations aside, the Federal Reserve Board is not, nor should it be, exempt from this oversight. This argument is crucial because it reinforces the checks and balances designed to prevent any single branch of government from exercising unchecked power. Clement's arguments extend beyond constitutional principles to the practical implications for the dual banking system. He argues that the Federal Reserve's discretionary power To deny master accounts to state-chartered institutions like Custodia undermines the balance between federal and state regulatory systems. This imbalance threatens the innovation and diversity that the dual banking system aims to promote. Clement provides a historical perspective highlighting the origins of the dual banking system going back to the Civil War and its role in fostering financial innovation. By granting undue power to the Federal Reserve, the current system deviates from this historical precedent, centralizing authority in a way that stifles competition and state-level regulatory experimentation. The dual banking system was designed to create a healthy balance between federal oversight and state innovation. Clement argues that the Federal Reserve's current practices disrupt this balance, leading to a more centralized and less dynamic banking system. This disruption not only affects state sovereignty, but also limits the potential for financial innovation and diversity. Clement's brief builds his case on constitutional grounds, arguing that the Federal Reserve's actions violate several key principles enshrined in the U.S. Constitution. These include the Appointments Clause, the separation of powers, and the necessity for judicial review to prevent administrative overreach. Clement emphasizes that the separation of powers is a fundamental principle that ensures no single branch of government can wield unchecked power. By allowing unelected officials at the Federal Reserve to make significant regulatory decisions without proper oversight, this principle is compromised. The brief points out that the separation of powers was designed to prevent the concentration of power and to protect individual liberties by ensuring that legislative, executive, and judicial functions remain distinct. Clement argues that the Federal Reserve's actions blur these boundaries, granting quasi-legislative and quasi-judicial powers to the executive agency. Clement's arguments have broader implications for how constitutional principles are applied in the context of modern administrative agencies. He suggests that the issues raised in Custodia's case are not isolated, but indicative of a larger trend where federal agencies increasingly operate with autonomy that challenges constitutional limits. By bringing these arguments to the forefront, Clement's brief builds on his victory against Chevron in Loper-Bright and invites the courts to again reconsider the extent of administrative agency powers and reinforce the constitutional boundaries that must govern their actions. This approach not only addresses the specific issues faced by Custodia Bank, but also aims to further cement precedent for future cases involving federal regulatory agencies. And then there's a quote here, but even setting that history aside, the critical importance of master accounts to state-chartered banks and the serious constitutional questions that the decision below raises make this case a paradigm example of the circumstances in which constitutional avoidance principles should control. Allowing the decision below to stand will enable politically unaccountable federal officials to exercise broad discretion to place massive and unwarranted obstacles in the path of state-chartered financial institutions, upending the traditional balance between federal and state banking regulators and affording Federal Reserve Bank presidents expansive power without meaningful political or judicial oversight. Whether as a matter of federalism, the Appointments Clause, or both, the judgment below cannot stand. The Blockchain Association's amicus brief was filed by Donald Verrilli, who served as President Obama's Solicitor General. It brings a tech and innovation-heavy perspective, championing the cause of financial innovation and digital assets. And here's a quote, "Unfortunately for Custodia, its application was caught in the current of federal regulators' aggressive coordinated efforts to debank the digital asset industry. Beginning in 2021, federal regulators began rolling back prior guidance that had permitted depository institutions to provide digital asset services and imposing new restrictions." Verrilli's brief centers on the critical role of innovation in the financial sector. It contends that the Federal Reserve's denial of Custodia's master account application stifles technological advancements and limits the potential for financial inclusion. The brief underscores that innovation is not just a buzzword, but a necessary evolution for a dynamic financial ecosystem. The brief highlights the burgeoning field of digital assets and fintech, emphasizing that these assets are now deeply embedded in the financial system, and institutions like Custodia are at the forefront of this revolution. It argues that by denying Custodia access to Federal Reserve services, the Federal Reserve is intentionally hampering the growth of these cutting-edge financial technologies. The brief advocates for an inclusive financial system that supports digital asset integration, ultimately benefiting consumers and the broader economy. A cornerstone of the brief is the argument for non-discriminatory access to Federal Reserve services. It posits that all depository institutions, regardless of their focus on digital assets, should have equal access to the essential services provided by the Federal Reserve. This access is crucial for fostering a level playing field where innovation can flourish without regulatory bias. Despite the digital asset industry's pressing need for banking services, federal regulators have waged a concerted, coordinated campaign to debank the industry. That effort is central to a complaint recently filed against FDIC by an affiliate of Coinbase, the United States' largest and only publicly traded digital asset trading platform, and is widely acknowledged in the financial sector. Wyoming's Attorney General steps into the ring with a staunch defense of the state's regulatory prowess. This brief is a clarion call for recognizing and respecting the meticulous framework Wyoming has established for special purpose depository institutions. The Attorney General's brief is grounded in the defense of state sovereignty. It argues that the Federal Reserve's denial of Custodia's master account application undermines the authority and innovation fostered by Wyoming's robust regulatory framework. The brief emphasizes that states have the right to regulate financial institutions within their borders, and that this sovereignty is crucial for financial innovation. The brief examines the specifics of Wyoming's regulations for SPDIs, highlighting their comprehensive nature. It argues that Wyoming's framework provides robust oversight and consumer protections, that it should be recognized and respected by federal authorities. By denying Custodia's application, the Wyoming Attorney General accuses the Federal Reserve of dismissing the effectiveness of state-level regulation. And a quote from here, a disregard of Wyoming's right to charter depository institutions in the two-tier banking system appears to be the motivation for this disparate treatment of Wyoming chartered banks. Indeed, the appellees appear to have arbitrarily created a distinction between federally regulated and non-federally regulated banks. Wyoming has positioned itself as a leader in financial innovation, particularly with its support for SPDIs. The brief argues that the Federal Reserve's actions stifled this innovation, hindering the development of new financial products and services that could benefit consumers and the economy. It underscores the importance of allowing states to experiment with and implement innovative regulatory approaches. The Attorney General's brief criticizes the Federal Reserve for deviating from its historical practice of granting master accounts to a wide range of depository institutions. It argues that such inconsistency undermines the predictability and stability of the financial system. By maintaining historical practices, the Federal Reserve can ensure a stable and predictable regulatory environment. By denying Custodia's application, the Federal Reserve has violated a long-standing principle of equality between federally chartered and state-chartered banks. The brief argues that such overreach not only disrupts state-led innovation, but also sets a dangerous precedent for the centralization of financial regulatory power. Another quote, this has created a Kafkaesque situation where an SPDI bank is denied a master account because it is not federally regulated, even while it is also denied federal regulation. This situation frustrates Wyoming's regulatory scheme and its right to charter state banks. The amicus brief from the Americans for Prosperity Foundation emerges as a powerful advocate for non-discriminatory access and regulatory accountability. This brief is wide-ranging and covers many areas also touched on by other amici, such as federalism, protecting innovation, and state sovereignty. It emphasizes the critical need for the Federal Reserve to operate within clear statutory mandates, ensuring fairness and equality in the financial system. The AFP brief argues that the Federal Reserve's denial of Custodia's master account application blatantly violates 12 U.S.C. Section 248A, which mandates equal access to Federal Reserve services for all depository institutions. By refusing Custodia's application, the Federal Reserve is accused of engaging in discriminatory practices that undermine the statute's intent. AFP underscores that statutory mandates must be followed to maintain fairness and integrity within the financial system. And a quote, "For the dual banking system to function as Congress intended, state-chartered banks must be able to access the Federal Reserve services and receive a master account as a matter of right and on equal terms with federally chartered banks." A significant thrust of the AFP brief is its focus on the Administrative Procedure Act. It argues that the Federal Reserve's actions are arbitrary and capricious, thus violating the APA. The brief highlights the importance of the APA in ensuring that federal agencies operate transparently and within the bounds of their authority. By failing to adhere to these principles, the Federal Reserve's decision-making process is called into question. AFP strongly advocates for robust judicial review to keep federal agencies in check. The brief posits that judicial oversight is essential to prevent federal overreach and ensure that regulatory bodies like the Federal Reserve adhere strictly to statutory and procedural requirements. This stance aligns with the recent judicial trend towards curbing administrative overreach, ensuring that agencies do not operate beyond their legally defined limits. The AFP brief emphasizes the need for transparency and accountability in federal regulatory actions. It argues that the Federal Reserve must be held accountable for its decisions, which should be subject to public scrutiny and judicial review. This approach ensures that regulatory practices are not only fair and equitable, but also visible and accountable to the public and other stakeholders. This amicus brief was submitted by members of the United States Senate Banking Committee and House Financial Services Committee, specifically Senators Cynthia Lummis and Steve Daines, and Representative Warren Davidson, and stands out with a sharp focus on statutory overreach and the need for regulatory consistency. This brief argues that the Federal Reserve's actions threaten the balance and predictability necessary for a stable financial system. The congressional brief argues that the Federal Reserve has overstepped its statutory authority by denying Custodia's master account application. It contends that the denial not only violates the clear mandates of 12 U.S.C. Section 248A, but also represents a broader trend of federal agencies exceeding their legal boundaries. The brief meticulously outlines how the Federal Reserve's actions contradict the statute's intent to ensure non-discriminatory access to Federal Reserve services for all depository institutions. It also addresses the broader implications of the Federal Reserve's actions on financial stability and innovation. By denying access to state-chartered institutions like Custodia, the Federal Reserve stifles competition and innovation within the financial sector. The brief argues that maintaining a consistent and predictable regulatory environment is crucial for fostering innovation and ensuring the stability of the financial system. And a quote, "Despite original concerns from some that the MCA would destroy our dual banking system, application of the law over the past 44 years has proven that those fears were unfounded because dual banking system remains alive and well today, as Congress intended. Should the district court's decision be affirmed, however, it would serve as a quasi-legislative paradigm shift that would subvert the state's role within our dual banking system." The amicus brief from the Wyoming Secretary of State takes a direct approach, arguing that the district court's opinion opens the door for the Federal Reserve to erode state sovereignty and dismantle the dual banking system without congressional approval. Wyoming Secretary of State shines a spotlight on the Federal Reserve's encroachment upon state regulatory authority. By denying Custodia's master account application, the Federal Reserve is not only undermining Wyoming's innovative financial framework, but also violating federal statutes designed to balance federal action with state sovereignty. At the heart of the brief is the interpretation of 12 U.S.C. Section 248A, a statute mandating that all Federal Reserve services be available to depository institutions, which necessarily includes those chartered by states. The Wyoming Secretary of State argues that the Federal Reserve's attempt to use a discretionary standard to deny Custodia's application directly contravenes the plain language and intent of this statute. The brief then discusses the dual banking system's significance, emphasizing its role in promoting financial innovation and diversity. By encroaching on state authority, the Federal Reserve threatens the delicate balance that allows both federal and state regulators to coexist and thrive. This balance is essential for fostering a robust financial system where innovation can flourish without undue federal interference. Wyoming's pioneering approach to business and financial regulation as the birthplace of limited liability companies and now special purpose depository institutions is highlighted as a model of state-led innovation. The brief argues that the Federal Reserve's actions stifle this innovation, limiting the potential for new financial products and services that could benefit consumers and the broader economy. And a quote, "Can the Federal Reserve say with a straight face that a 772-page bank examination manual for SPDIs is really a race to the bottom, especially while the Federal Reserve itself allows such activities to take place in other banks today without adopting any standards for banks at all?" Former Senator Pat Tomey's amicus brief takes a firm stand on the necessity of transparency and legislative oversight. Unlike the other amici, Senator Tomey has submitted a neutral brief and does not explicitly support Custodia. He does, however, highlight the urgent need for clear guidelines and public accountability in the exercise of the Federal Reserve's powers. As explained above, the 2023 NDAA amendment does not and was not intended to grant or opine on any substantive rights of the board or any of its reserve banks. The amendment was drafted in response to the board's and Kansas City Fed's refusal to address repeated Senate inquiries into the handling of Reserve Trust Master Account application. Senator Tomey's brief underscores the critical importance of transparency in federal regulatory actions. It argues that the Federal Reserve must operate with clear, publicly accessible guidelines to ensure that its decisions are fair, consistent, and open to scrutiny. Noting that the Federal Reserve has a historical problem with transparency, it emphasizes that without more transparency, regulatory actions can become arbitrary, undermining public trust and the integrity of the financial system. A quote, "The Senate Banking Committee witnessed the lack of transparency in the master account approval process firsthand in January 2022 during the Senate vetting and confirmation process for a presidential appointee nominated to serve as vice chair for banking supervision of the board." Tomey's brief places significant weight on the legislative framework governing the Federal Reserve's actions. It discusses recent amendments and legislative changes, stressing that any major regulatory decisions must be explicitly authorized by Congress. This focus aligns with recent judicial moves to curb administrative overreach, reinforcing the need for regulatory bodies to operate within clearly defined legislative boundaries. The brief then goes into the legislative intent behind key statutes, arguing that the Federal Reserve's non-transparent denial of Custodia's master account application deviates from the principles those laws were passed to specifically address. Tomey asserts that the Federal Reserve must respect the boundaries set by Congress, ensuring that its actions reflect legislative intent rather than unchecked administrative discretion. Senator Tomey's brief argues that for enhanced legislative oversight of federal regulatory bodies, by reinforcing the role of Congress in setting and overseeing regulatory policies, the brief seeks to ensure that federal agencies remain accountable to the public and their elected representatives. This approach is intended to safeguard against arbitrary regulatory decisions and promote a more accountable regulatory environment. The various amicus briefs submitted in Custodia's appeal present myriad arguments against the Federal Reserve's actions, ranging from constitutional arguments to statutory interpretation and the broader implications for financial innovation. The central theme, however, is that an unrestricted, unreviewable Federal Reserve System is neither supported by the Constitution nor a healthy and desirable outcome for our country. As the legal battle unfolds, the arguments presented in these briefs will play a crucial role in shaping the future of financial regulation and state sovereignty in the United States. Very nice piece, and a lot of really good commentary in there. And I just, as I'm reading through this, I just can't help but think about ending the Fed. And finally, I did want to highlight this week's featured post on Bitcoin Fortress Substack. It's entitled Supreme Court Chevron Decision, a Libertarian Perspective. So I'll include a link in the show notes. Check it out. If you like what you see, you can subscribe for free. And if you'd like to have a paid subscription to help support me, that would be great too. but that is on Substack. Before I wrap up, I did want to give a shout out to this week's top boosts on Fountain. We have at God's Death with 236 sats. Thank you very much. And at Duke Nukem with 200 sats. And thank you as well. And thanks to you all for listening to the podcast. If you enjoyed the show, please like and leave a comment. Don't forget to subscribe on your favorite podcast app so you don't miss an episode. I enjoy listening on Fountain, where I can earn sats just for listening. You can also follow my Substack. It's at bitcoinfortress.substack.com. And you can follow me on Nostr. I do include my NPub in the show notes, so you can reach me there. And with that, I will talk to y'all next week. Bye-bye.